Good morning. I'm Vanda Vickers, Chief Operating Officer at the Global Risk Institute, and I'm delighted to welcome you to our webinar today, Responsible AI in the Financial Services Sector, Unveiling the EDGE Principles to Enhance Risk Management. I'd like to open this webinar with a formal statement recognizing the unique and enduring relationship that exists between Indigenous peoples and their traditional territories. The Global Risk Institute is headquartered in Toronto, which is situated on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat people, and is now home to many diverse First Nations, Inuit, and Métis people. Finally, I acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit First Nation. Before we dive into today's exciting session, there are a few housekeeping details to review. Please note that your microphones have been muted to avoid background noise, and we've allocated plenty of time for questions, so please submit them through the chat box located at the bottom right-hand corner of your screen. We'll address as many of your questions as possible during the Q&A portion of this event. This session is being recorded and will be shared on the GRI website. And finally, when leaving the event today, you'll be prompted to take a survey. Your feedback is very important, and we encourage you to complete our survey to inform future events like this one. So about a year ago, GRI embarked on a journey with our colleagues at OSFI to partner with experts in the industry, both financial services and leading AI experts, regulators, academics, to develop a framework for responsible AI, which we'll discuss today in detail. Artificial intelligence is a simulation of human intelligent processes by machines, especially computer systems, and specific applications of AI include expert systems, natural language processing, speech recognition, and machine vision. AI is a competitive imperative, not a choice for the financial services sector. AI is not merely an option, but a powerful tool that, by leveraging insights from data, automating processes, improving efficiency, and offering innovative products and services, it will empower financial institutions to lead the way to surpass their competitors. Complex regulations are needed, and they pose challenges that demand precision and accuracy. AI can play a pivotal role in insurance regulatory compliance by automating and monitoring and reporting, enhancing accuracy, and reducing the risk of non-compliance. By embracing AI, financial institutions can navigate the regulatory landscape more effectively. This partnership between OSFI and GRI created the Financial Industry Forum on Artificial Intelligence, which created a document which is posted on the GRI website, which actually documents the principles that we will be talking about today. We gathered Canada's financial services experts from industry, government, and academia on the application of AI. The rapid growth in digitalization and uses of AI across the sector highlight how current risk frameworks must adapt to remain relevant, forward-looking, and responsive to industry needs. So today, I'm very pleased to introduce our two speakers. Romana Mizrak is the Managing Director of Risk Quantification at the Office of the Superintendent of Financial Institutions, OSFI. With 20 years in the financial services sector in Toronto, she has worked with various technical roles and is very versed in the model risk management, including quantitative analysis, risk monitoring, and model validation. In her current role, Romana leads a team responsible for review and approval of regulatory capital models, assessment of model risk at the enterprise level, and industry-wide risks, sector-specific needs, and developments related to model risk and use of advanced analytics. Alexei Rubtsov is a Senior Research Associate at the Global Risk Institute and a tenured Associate Professor of Mathematical Finance at Toronto Metropolitan University. His areas of focus are AI, systemic risk, climate change risk, and asset allocation. He's been published in top-tier journals, and he actively contributes as a member of scientific committees for workshops specifically focused on AI-related themes. So we'll begin today's sessions with remarks from Romana, followed by Alexei, and then we'll move to a Q&A session. Romana, over to you.
Good morning, everyone. Thank you, Wanda, for the introduction. So firstly, a big thank you to Global Risk Institute for organizing this webinar, inviting me to participate. As Wanda noted, I'm a Managing Director of Risk Quantification at the Office of the Superintendent of Financial Institutions. And actually, just very recently, I resumed this responsibility. And in my current role, I'm responsible for advancing stress testing capabilities, conducting macroprudential assessments of vulnerabilities and risks in financial sector, and staying abreast of research and innovation in advanced analytics. And in my previous role, I was responsible also for model approvals. So Alexa and I will talk to you about a work that was jointly conducted by the Global Risk Institute and OSFI, as Wanda already mentioned. And in fact, OSFI partnered with GRI, recognizing the importance of reaching out to a broad and credible subject matter experts in AI space as we were embarking on a journey to update model risk guidance. So there is a certain order I like to follow when I talk about AI, and I'll start the presentation with the present state of AI, and I'll include some recent examples. And generally here I go for the wow and the shock factors, which, as we know, with AI is not difficult. And then I'll spend a few minutes talking about the work OSFI did in AI space up to now, before I pass the mic to Alexei, who will take you through the meat of this presentation. I will draw a parallel between AI regulation and regulation of other past innovations that have tremendously changed our lives. Next slide, please. So the progress of AI in the last few years, and actually in the last few months really, has been unprecedented. We now live in the era that's expected to catapult AI to the new heights that will surpass human intelligence across all fields. And some believe AI will achieve this by 2029. So once we achieve this artificial superintelligence, and whether it's in 6 years or more, life will likely become almost alien to today's observer, similar to how we view today life in 1940s and 50s. We already have generative AI models such as large language models, which are capable of generating text, images, and other media. As we know, some of them use neural network architecture, billions of parameters, and are trained on massive amounts of data. So just to illustrate a point with few numbers, I think you cannot have an AI presentation without some stats. So the model that underlines ChatGPT is reported to have 175 billion parameters and has been trained on over 500 billion words. So that's over 45 terabytes of data. Of course, the benefits of such models are immense, including language translation, text classification, improved business productivity, faster and better research and development, drafting reports, and so on. The list goes on and on. And my favorite clipping that you see on the screen is a reference to detecting breast cancer 4 years before it even developed. And in fact, I learned last week from Carol Pjovensen, she's an AI expert on the policy side and someone who I immensely admire, that there are claims suggesting a person who will reach 200 years of age has already been born. And of course, this is due to rapidly advancing biomedical technologies, including tissue engineering, gene therapy, stem cell therapy, cloning. There's even discussions about memory uploads. So now turning back to finance, Morgan Stanley, for example, is developing a service that leverages OpenAI technology that will deliver relevant content and insights into the hands of financial advisors in seconds, so really helping drive efficiency and scale. So this is, of course, all wonderful and fantastic, but can we truly trust AI? Next slide, please. So unfortunately, there are issues that are extremely worrisome, such as propagation of bias, generation and distribution of fake news, and content manipulation that can impact fundamental social rights, freedoms, and order, just to name a few. These algorithms, as we know, can detect incredibly complex patterns from massive data sets. So this means that even subtle bias can be picked up by the algorithms and then magnified significantly. And when I think about this and the impact, I always think about the damage single bias credit underwriter, whether that bias is conscious or subconscious, can do in a day versus a fully automated underwriting tool that has a much wider reach. So as we know, the power of AI comes from complex algorithms that are trained on massive data, which sometimes also leads to the black box nature of these models. And without explanations or not understanding how the model works, their robustness cannot be guaranteed. With generative AI, as some of you have probably heard, harm could be caused. There could be privacy issues, legal issues, intellectual property issues as well. So it seems that as we come up with bigger and more sophisticated uses, there is also the likelihood of bigger issues if they're not mitigated during or really throughout the entire life cycle of the model. And so some of these concerns are what led us to our AI ML journey, since we recognize the importance of a balanced guideline. So meaning we have a guideline that will contain proper guardrails that will support strong risk management, while at the same time allowing institutions to continue to innovate. Next slide, please. So we started our journey in 2019 with the purpose of exploring the uses of AI/ML at the institutions we regulate, and to understand the risks and challenges arising from their use so that we could provide proper guidance and supervision. As you can see from the slide, there's been a lot of work to date. First, we conducted a survey, and here we took a deliberate approach and asked open-ended questions, especially as it pertained to the definition of key terms, because we wanted to understand how institutions were defining and experiencing AI. And then in 2020, OSFI published discussion paper on technology risk, and here we introduced 3 principles that we believed are appropriate to address AI/ML model risk, and we call those principles C principles, which stands for soundness, explainability, and accountability. And the following year, we engaged in 4 deep dive studies looking at detailed use cases to understand better the whole life cycle of AI models from ideation to deployment. Then in May of last year, we published a letter communicating the intent to update model risk guidance. And then later in the year, we focused on bringing together a wider group of subject matter experts through partnership with GRI and creation of Financial Industry Forum on AI. And so I'll expand on that in a minute, and then Alexia will walk you through key principles that came out of those discussions that are also described in our report. So it's gratifying to see that we are not alone in this work. Many jurisdictions are in discussions on the appropriate level of guidance for these models, and there's been publications of different documents in this regard. And the latest on the regulatory front is the EU AI Act, and this is being considered as one of the most comprehensive AI laws that has recently passed, actually passed just a few days ago in Parliament. Next slide, please. So throughout this journey, our thinking has evolved. So we started thinking that we need to work on, or issue rather, a specific AI/ML guidance. And then very quickly, we shifted to developing an integrated model risk guideline that will cover all models, all institutions we regulate, with proportionality principle in mind, of course. We knew that we had to consider broader issues such as fairness. And now we understand that OSFI's model risk guidance is not a sole home for some of those broader issues. There are other stakeholders that need to play their part. We started exchanging information with domestic and also international regulators. And now I'm proud to say that we collaborate closely with peer regulators with an objective to provide thorough and consistent guidance, and in that way contribute to safe and responsible adoption of AI in Canada and globally. Next slide, please. So we partnered with GRI to create a forum. So a forum of experts in AI/ML to discuss current and forward-looking risks and challenges arising from the use of these techniques. So we had 4 full-day workshops with selected participants from public and private sectors, as well as academia and research centers. And here our objective was to discuss and share perspective on risk management best practices that are notable to AI topics, deepen our awareness in specific areas, including data, explainability, fairness, and so forth, help advance model risk management best practices in the industry, and also inform OSFI update to guidance. As part of the workshop, we also ran a regulatory panel, and the regulatory perspective is important because we need to ensure that we have a robust guidance that properly balances guardrails while supporting innovation at the same time. And so a few themes came out of that panel, including importance of ensuring cooperation and consistency. It's very difficult for one regulator to stay on top of everything. I think there is a collection of regulators that really need to work together to make sure that all of it is covered. Small institutions adopting AI will likely reach to outsourcing perhaps more than large institutions due to resource constraints. And so we need to be mindful of some of the risks that come with outsourcing. Innovation within regulation is also important. That was discussed through the panel as well. So regulators themselves need to embrace the technology, beta test it for their own purposes, create open source spaces for safe innovation through use of sandboxes, collaborating with industry and academia, and also actively sharing amongst each other. And we also talked about importance of proportionality and outsourcing, which I already mentioned. Next slide, please. So just as we welcome participants from various sectors, we did the same for keynote speakers. And as you can see from the slide, we had a diverse group of senior leaders who bring a lot of experience and wealth from different sectors. Internationally, we also had representation from US, UK, and Singapore. Next slide, please. So I thought that before I pass the mic to Alexei, I wanted to comment on the speed of regulation, as this is something that often attracts attention, and there's general criticism that regulation is playing catch up with innovation. So I wanted to take a moment to share with you the analogy that my colleague recently shared with me between the development of AI and the development of automobiles at the beginning of the last century. So it took many years for automobiles to become what they are today, which is basically an integral part of our lives and very carefully regulated industry in many different aspects. Unfortunately, some of these regulations and standards only came after accidents had happened. So the legislation went back and forth until a balance between allowing for innovation and preventing the risk was found. So for example, the speed limit, which did not exist at first, was initially set at 10 miles per hour, and that was back in 1861. Then it was decreased to 4 miles per hour, which essentially eliminated the advantage of cars over horse-drawn carriages. Then it moved to 20 miles per hour, only to be removed because of the inability to enforce it. And then after many deaths, it was set at 30 miles per hour in urban areas, which is close to what we have today. And that path took over 70 years. So I brought up this example because it demonstrated regulation is an iterative process, and I expect the same to be true for AI regulation. I truly hope that we don't have decades before we can say that AI innovation and regulation are in lockstep. So what will speed up this process, in my opinion, is constant iteration and collaboration. So with that, I'll pass the floor to Alexei. So Alexei, over to you. Thank you.
Thank you very much, Romana. Yes, that was indeed a very exciting journey with OSFI last year. So in my presentation, I really would like to share the main insights that were observed and obtained throughout the forum. So there are 4 principles that came out of the forum that are referred to as explainability, data, governance, and ethics, and they're commonly referred to as the EDGE principles. So now I would like to delve into each of those individually. So explainability. So in simple terms, explainability means being able to understand and explain why an AI system makes a particular decision. And one of the key things that explainability enables is ensuring that the right decision is being made for the right reason. To illustrate this point, consider the following example. So suppose an insurance company So levels of explainability here. Different AI tools have different levels of explainability. and it's not clear which AI tool we should use. So it depends on the risk and materiality of the use case. And in that sense, low levels of explainability are acceptable for low risk cases. Whereas high levels of explainability are required for high risk cases. And when we talk about high risk cases, we think about capital calculations, which are essential for financial stability, and lending decisions. Next, what constitutes a good explanation? It depends on the risk and materiality of the use case, of course, and depends on what party needs an explanation. It's also important to recognize the importance of transparency. When it comes to transparency, of course, we think about disclosure. Disclosing too much in the explanations could lead to loss of intellectual property, and excessive transparency could also make our AI system vulnerable to adverse actors who could game the AI system. In general, the details included in disclosure should depend on the risk of the use case, and companies should strike a balance between disclosing enough information to satisfy customers and investors, while keeping sensitive information confidential to maintain their competitive edge. I would also like to comment on the balance between explainability and performance. It is commonly perceived that to achieve high levels of performance, we need to use black boxes, highly obscure tools, machine learning tools. And one viewpoint suggests that by significantly improving the quality of data, interpretable models can achieve performance levels similar to black box techniques. On the other hand, there is also a possibility of relying on highly performing models, even if those models are not inherently interpretable. These contrasting perspectives highlight the ongoing discussion that surrounds the relationship between explainability and performance in different contexts. It is also crucial to recognize the limitations of some explainability techniques. It's important to note that while explainability is believed to assist in identifying biases, it is possible for some techniques to overlook certain biases, meaning that biases may exist but may not be reflected in the explanations provided. And a few years ago, there was a study conducted by different researchers who actually came up with examples when well-known explainability techniques failed to identify biases that were present in the model. It is also commonly believed that explainability is critical for trust, which is indeed the case. We do need the tools that used by financial institutions to exhibit a certain level of explainability, so that we get so that we can trust these tools. However, it is also possible that transparency could diminish trust. And a good example would be an explanation that is too long to understand. Think of an explanation that is 100 pages long. So it could, if not properly implemented, explainability can actually diminish trust in the system. And now let's consider the following example with the insurance industry. This example will make a point that explainability is important to make sure that right decisions are being made for the right reason. Suppose an insurance company wants to develops an AI tool to assess risk and determine premiums for auto insurance policies. The model achieves high accuracy, but it heavily relies on one variable, age, to determine premiums for auto insurance policies. So what actually happened is that the model learned a spurious correlation between age and claim risk. Indeed, young drivers have less experience and may have a higher frequency of accidents. As a result, younger drivers are assigned high premiums and more senior drivers assigned low premiums. However, this correlation may not reflect the true causality between age and driving behavior. Other important factors, such as driving experience, location, and vehicle type, could also significantly influence claim risk. So explainability is critical to make sure that right decisions are being made for right reasons, because there is a chance that right decisions, high performance, could occur for the wrong reasons. So next, I would like to talk about data. So it's the second principle that was discussed at the forum. So given the data used in training AI models is typically very large, ensuring its quality and diversity is a fairly challenging task. This is particularly true for unstructured data, which includes texts, images, audio, and videos. At the same time, checking data quality is critical for safe use of artificial intelligence. And here is an example from the New York Times. The richness of ChatGPT underlying data can give the false impression that it is an unbiased summation of the entire internet. And it was recently reported that ChatGPT was found to be biased in its political views. The political views were reported as being liberal, progressive, democratic, and of course, it's not something that conservatives liked. So their idea was to develop their own chatbot. But of course, if we have too many chatbots developed by different parties, it could diminish trust in the technology. On the other hand, given the fact that the chatbot was trained on almost the entire internet, makes it very, very challenging to have certain procedures in place in regards to figuring out how to ensure that there is no data in that, there is no bias in the data that is used to train the chatbot. There are a few factors that were discussed in regards to data. So first is for third-party impact. Organizations need data beyond those generated from their business activities. Therefore, they have to rely on third parties. In such cases, for example, it becomes very important to ensure that the data vendor obtain proper consent from the data subjects before sharing the data with financial institutions. Furthermore, ongoing consent management might be required, because in many instances, the data was collected for one purpose, and then later on it was found that the data could also be useful for other purposes, but the data subject did not provide consent for that usage, so it could complicate things down the road. Next is about data governance, which is critical for financial institutions, considering the sensitive and confidential nature of financial and customer data. For instance, where personal or sensitive data is present, data privacy and security are essential. During the forum, it was brought up the following difference in jurisdictions. There is no consensus across jurisdictions on the suite of variables that should be deemed as protected variables. Creating strong data literacy culture is also important for organizations that use artificial intelligence. It is crucial for everyone in the organization to understand the risks that come with when data is used improperly. To achieve this, organizations could provide continuous training for employees on different aspects related to data. This will help ensure that employees are well informed and aware of the potential challenges associated with adoption of AI. AI also cannot be considered in isolation with increasing digitization of our society. The two important developments in this respect are the Internet of Things and open banking that have the potential to intensify concerns about data privacy, since now more actors in the market could access data. This can make holding individuals accountable more challenging, especially in open banking, where data from one party can be used by another party. However, data sharing through open banking could also have benefits, such as detecting biases and improving AI model performance, because it just implies that we have more data to train our algorithms. It could be challenging to ensure that data strategy accounts for the specific requirements of AI, and it supports organizations' overall business strategy. Why? Because it is not always evident how to quantify the benefit of investing in data strategy, especially when compared with other immediately profitable business projects. And this, in turn, could lead to sub-prioritization of strategic data-related projects. Next, I would like to discuss the governance. It's the third principle. And I would like to start with what constitutes a good governance. So first, a good governance should reflect the risk of use cases. It should be flexible as a financial institution's adoption of AI tools matures. Roles and responsibility should be clear and well articulated. And it should be holistic and encompass all levels of the organization. Modifying existing governance framework is a better approach than developing a suite of new AI-specific processes and procedures. Developing a robust governance framework inclusive of AI might involve a significant culture change as more areas of financial institutions apply AI techniques. And traditionally, financial institutions with mature governance framework maintain a model inventory, which could be expanded to incorporate all AI models. The exact composition of AI governance structure, of course, will vary from one financial institution to another, and of course, it will depend on such factors as the institution size and the sophistication of enterprise governance frameworks. It should also be pointed out that AI model governance can be more complex than traditional model governance because it requires multidisciplinary approach. Here we're talking about experts in law, experts in ethics, expert in data science, machine learning, computer science, in cybersecurity. So this multidisciplinary approach is indeed critical, and this approach should be rather holistic. Governance is needed for open source code commensurate to the risk of the particular use case. In lower risk use cases and where permitted by the enterprise risk appetite, financial institutions may use open source without rigorous review process. However, in high risk use cases, financial institutions should have an independent review of its open source code. And this point is particularly important because, as we all know, there is a lot of open source code when it comes to artificial intelligence and machine learning. And this open source code is, of course, easily available for use. Since AI systems have capacity of autonomous decision making, there is also a risk of reduced human oversight on important governance aspects. The best practice to address this is, of course, the changes in the control framework, which include increasing the frequency of monitoring to help reduce the risks associated with automated decision making. So this could be very important for such system to be frequently monitored. Organizations may also need to frequently provide training and development opportunities to help both business and technology employees adapt new technologies and workflows. Some financial institutions, as was identified throughout the forum, are already implementing AI-specific training programs that include law, such as privacy, governance, human rights, cybersecurity, and domain-specific knowledge, of course. And finally, I would like to discuss ethics. So the following pyramid hierarchy illustrates the importance of considering both legal and ethical aspects while balancing them with the organization values. So at the bottom of the pyramid, we have organizational values. These are the beliefs and principles that the organization thinks are really important. When making choices, it's essential to think about and support these values because they represent what the organization is truly standing for. The next is ethics. This is about doing the right thing based on what most Canadians consider morally good. Even though these things may not be written down as laws, they are still important to think about. And finally, at the top of the pyramid, we have law. This is the official set of rules that everyone needs to follow when doing business in Canada. There are a few other factors that I would like to discuss when it comes to ethics. So first is that ethics is not a well agreed upon concept. So it varies across different jurisdictions and over time. So let's say 50 years ago, ECG discussions were not that prevalent as they are today. So decisions made by financial institutions could also change over time when it comes to ethics. Next is the definition of fairness. Fairness does not have a universally agreed upon definition. What is considered fair could vary greatly depending on the specific circumstances and context. And different definitions of fairness can actually contradict each other. And there was a study conducted a while ago that compared multiple definitions of fairness. The findings of the study indicated that it is highly unrealistic for all these definitions to be simultaneously met in practical situations. And finally, bias. Although bias is typically perceived as something which is, when unfairness is discussed, something negative, bias can actually be a good thing. And it could happen in certain situations that there may be a deliberate intention to introduce bias into our model in order to align it with organizational values. Again, for example, ECG policies. It could be like a natural feature in the model itself. So bias can have all forms, and it's not necessarily a bad thing. So that should also be recognized when developing AI models. And finally, I would like to note that the edge principles that were distilled throughout the forum can be seen as a framework, as lenses through which we can assess the riskiness and the benefits and the risks of a particular AI tool. So, and that concludes my presentation. So, Vanda, back to you.
Thank you very much, Alexei and Romana. I think those were valuable insights for us to think about. I'll remember to, I'll send a memo, something out to all our participants. Remember that we can ask questions using the chat function. I encourage you to just type them in and I will moderate them for our panelists today. But let me start with you, Romana. I think you mentioned that we have quite a series of there's a lot of regulators who will be interested in understanding how they work together to do this. It is a very wide topic. And so how do you feel, as a group interested, like where will the interdisciplinary collaboration between the regulators, industry will happen? Like how can we actively continue to engage all these diverse groups and all the diverse regulators? What's your thought on that?
Thank you, Wanda. It's an excellent question. And I personally think that regulators have a large role to play in bringing a wider group of stakeholders together and ensuring that everyone's voice is represented and also heard. Regulators shouldn't be developing guidance in isolation. And, of course, we have subject matter experts in-house, but it's also very important for us to reach out and hear different views. And I've seen a shift in regulators in the last couple of years, in a sense that there is a wider, earlier outreach by regulatory community to other stakeholders and relevant subject matter experts. Just perhaps to name a few examples here, PRA has conducted public-private forum, and we have followed in their footsteps and organized the FIFI with GRI. I'm also aware that European regulators are actively seeking input from institutions they regulate, as well as academia, research labs. Monetary Authority of Singapore has done a lot of engagement with the industry as well. So I think having engagements such as forums that we did, it's very important. Regulators are also publishing papers seeking wider input from the audience, broader audience. US has recently requested information. Well, actually, they are seeking feedback from like I said, broad set of stakeholders and public at large. So I think it's important for regulators to collaborate, to share their plans, and to seek broader feedback. We are certainly collaborating with domestic and international peers, and I think this will help with the iterative process and ensuring that we bring a more holistic AI guidance forward sooner rather than later.
Great. Thank you very much, Romana. Alexi, I think that you touched on a couple of principles that we needed to maybe, what do you think is needed from, let's say, organizations from a knowledge standpoint? Is data literacy an important thing for people to understand when we're going towards this, world where data is going to be, widely used, wildly accessed?
Yes, thank you, Wanda, for this question. Indeed, at the forum, the data literacy was discussed at length. And some facts that were discussed were a bit surprising to us. For example, the data set that can be thought to be anonymized actually might not be anonymized when combined with other data sets. And of course, it could be very surprising to people to know it. So how do we ensure that the data that we collect is stored properly? So data stewardship here is also very important. And promoting that throughout different training programs within financial institutions is critical. Because the amount of data that we now can collect within financial institutions and use is rather large. And as I mentioned throughout the presentation, ensuring that data quality is at the level that at a very high level could be a very difficult task. It's just too much could be for a financial institution to handle. And at the same time, the performance of AI tools is highly dependent on the data quality. So that's why, just in summary, the data literacy is key when we talk about AI.
Mm-hmm. Mm-hmm. One question that we've received that I'd like to pose to the panelists, and it talks about data and our customers and their knowledge of what data is being used by them. Was there any discussion at the forum about modifications to KYC, know your client, that type of thing, where the knowledge that data is being used to come with decisions? Was that an area of discussion at the forum? And I'll direct it to Romana to start, and then Alexi to jump in since you were both there.
I can't explicitly remember this specific topic being discussed, but I think we recognize that it's, like as Alexa was saying, it's really important to understand where data is coming from, the purpose for what it's going to be used, and if the consent was given for a particular use case, then if there is a similar use case that it's considering to use that same data set, a different consent needs to be given. So I think that's very important. Transparency is extremely important. I'm trying to remember what else on that topic. Alexa, I don't know if...
I think that directs it. And Alexi, anything that you could recall that would, when you start considering where the data is coming from in the first place, and what the the use cases might be there.
Yes, of course. There were some discussions around alternative data because data is very important for financial institutions. And now, of course, data is a big business enabler. So it could give you competitive advantage if you use some data that could provide more insights. And again, we're going back to the issue of how to make sure that the data is of good quality. If it is obtained from a third-party provider, then the issue is that was the content obtained? So we have some ethical issues here and legal issues combined. Even if the tool is provided by a third party, the issue could be the third party cannot provide us everything about the tool because it's an IP, right, of the third party, and at the same time, it's the financial institutions who are liable for whatever if anything goes wrong with those third-party tools. But was the data used to train those tools properly obtained? And so there are all sorts of issues that could come out from these discussions of alternative data sources. But yes, the care should be taken when financial institutions are trying to diversify the pool of data that they work with.
So you'd say that some of this, and it would be coming under the umbrella of explainability. In other words, how the data is being used, when it's being used, how it's being, right? So it would like comment on that. How does that link back to explainability?
Explainability, of course. If we want to explain how the model works, and this model is coming from a third party, then putting too much in the explanation could pretty much tell me everything about the model. And I don't need a third party. I can just replicate this model internally. So third parties, of course, recognize this. And this is where there could be an issue here when it comes to transparency of tools that are obtained from third parties. And at the forum, one keynote speaker was actually mentioning, saying, don't develop it with using third parties, do it internally, completely internally, so that you can have full control of the data that you use for training and of the tools. But this is, of course, good for large organizations, but not so for small financial institutions who might not have enough resources to develop all these tools internally and, well, have all the processes and due diligence processes required for handling very large data internally.
If let's just jump to the area of trust and fairness and talking about fairness. I know that fairness is not something that uniformly has a level explanation everywhere. I mean, fairness is depending on context and where which jurisdiction people are sitting in, but maybe in the context of good corporate governance, like if we look at the concept of fairness, think about back the discussions in the forum, because I'm always going to come back to bringing these discussions back to how the forum discussed it and it was developed as one of the principles. But where is what is the role of governance in making sure that fairness is uniformly applied? What's your concept on that? Romana, maybe I ask you that one to start with.
Sure, thanks. So there was a lot of discussion on fairness and bias, and as both you and Alexei pointed out, it's a very challenging topic. As you said, it's very much situation content dependent. It changes over time. There are no uniform definitions of what's considered fair. So it's very difficult to develop. Perhaps in the ideal world, you would have, a clear set of expectations, and as long as you can meet those, you're fine. But that doesn't work. So I think it really has to come down to shared responsibility. Everyone has to do their part. And on the part of the institutions, I think it's important for them to incorporate their risk appetite, code of conduct, and ethical values as they're assessing fairness. And fairness needs to be assessed throughout the entire I would argue, life cycle or life of the model. I think it's very important that we understand different points at which bias can enter the model life cycle, starting from the data. Everyone kind of clings on the data. That's the obvious one, because we recognize that data comes with a lot of historical biases that truly come from us humans. But then there are other points that we can mitigate. For example, if you have if your modelers are all coming from the exact same background, a very similar background, you will likely have a bias there. So that's something you can avoid and be very mindful about it. Also, if you don't have a human in the loop, that could result in having a bias. So there are many different ways, or even perhaps choice of outcome measures, depending on which outcome measure you use, that could be a source of bias. Or so I think it's very important that we assess for bias and fairness throughout the entire life cycle. And again, it comes back to the risk appetite, a code of conduct, and ethical values of institutions. So there's a large role they have to play there. From the regulatory perspective, I think we would expect them to consider fairness and bias in their assessment.
Great, thank you. Romana, I'm going to go back to you for a question that's just reminding myself of a conversation we recently had. AI is a very wide topic. There's so many things to consider. So how do we get our arms around this? How do we look at all aspects of this going forward?
So I think in quick answers, I think you really need a group of regulators to work together to ensure they cover the entire space. And the analogy I often think about is like hugging a sequoia tree. You need a couple of people to hug a sequoia tree. And in the same way I think about AI and governance, you really need multiple stakeholders to make it work, and you need them to work effectively. And that includes collaboration amongst both domestic and international regulators, but also ensuring that they hear the voices from other relevant stakeholders, academia, private sector, technology companies, institutions themselves. So in Canada, for example, we have Bill 27. So that was authored by I said there is directive on automated decision-making from Treasury Board. AMF, which is a provincial regulator, has issued a paper that outlines recommendations for responsible AI. OSFI has Model Risk Guideline, or E23, which will soon be updated. So I think all these pieces need to connect, and so we need to work together to ensure that that's indeed the case. I think I was alluding earlier, there isn't a single regulator that can put his or her or their arms around this. So it comes down to, for me, it's effective collaboration.
Yeah, and it's moving very quickly. I think that's one of the things. I mean, when you were giving us the analogy of the automobile industry, they had years and years and years to get the right regulation around it. But going forward here, I mean, and I feel like we have the clash of two industries. I shouldn't say clash, but a very heavily regulated industry using technology and tools from basically a non-regulated industry, and making these things work together and making sure that everyone's moving forward in the right direction. So that must be a big discussion also.
Just one very quick comment. I mean, the speed of change is incredible. And so we had our last workshop, I think it was in November of last year, and there was barely any discussion there on generative AI or large language models. And if we had those sessions a couple of months later, I'm sure, half of it would be dedicated just to that topic. So it really demonstrates how quickly this technology is moving. So we really need to keep up with it.
Yeah, absolutely. I mean, one of the questions one of our attendees has asked us about large language models and how, only 2% of them, or I guess colloquially, have explainability. And I think that the use of LLMs are going to be very much something that we're going to have to look at how companies deploy them. I think there's a lot of need inside companies to make sure that they're adequately used and monitored, quite frankly. And I think that's something that needs to be really monitored in the next little while. One last question, and I think you alluded it to earlier, and I maybe ask Alexi first. And if I look at the, when you look at the speed of development, the speed of use, and do you think that an agile way of looking at the model, the principles that are around you and in companies, do you feel that companies are going to have to modify the traditional way of looking at, setting their internal management processes from a governance standpoint, given the speed at which AI is moving?
The answer is that the financial institutions will need to adapt. Yes, the speed of development within AI field is very fast, and this requires robust governance frameworks that could incorporate this change. Like immediately, then you alluded to large language models, which is indeed the case. And if we look at large language models from the perspective of the four principles, explainability is very difficult to address. Ethics is very difficult to address because there is a lot of data used to train those models. Data is also very challenging to address. However, governance is something that is, like, I would say, not that challenging to address, in the sense we can just stop using those models. On the other hand, of course, if we stop using them, we could like abandon the benefit that we could get from using those models internally. So when it comes to governance, there will need to be changes, but at the same time, I think it would be wise to have fairly robust governance frameworks that could be forward-looking, in the sense that all these AI tools can work together in some short to medium term under the governance frameworks. But adaptation of existing governance frameworks is key, of course, as well as for regulators. I think Romana will add it, and we quite often have those discussions with her when I ask her, do you need AI to regulate AI? So given how fast the field is developing.
So Romana, last word to you on that specifically. I think you alluded it to early, on the speed of which you're about to get into modifying regulation, but how fast are you going to be able to react? Have you had discussions about how do we deal with this? Since things, as you said, when we met in November, we didn't have the LLMs use that have been happening in the beginning of this year. So, what's the thinking around that?
So from the regulatory perspective, I think the way we approach this, or hope this is the right way, is to look at it from the principle-based standpoint. So developing principles as opposed to very prescriptive rules is something that perhaps can give us an edge and ensure that regulation keeps up with times. Of course, there needs to be constant iteration and updates. But I think on Alex's point on agility, that's a very important one. The days of taking 12 to 18 months to create a model, have it validated, and then put in production, I think those days are behind us, quite frankly. So I think the industry as well as the regulators need to adapt to that. And what we've seen in the industry, especially better practices, suggest that the way industry is approaching this agility is by bringing everyone to the table much sooner. So developers, validators, compliance departments, legal, so they all tend to come much sooner to the table and start discussing issues than perhaps in a more traditional sequential way. So I think the key is to achieve some of that agility is to have the proper stakeholders at the table earlier and make sure I keep coming back to effective collaboration point. That's very important.
Great. Thank you very much, Romana. Thank you very much, Alexi. We've already come to the end of our hour.